forward to probably our government's favorite topic, charitable and religious trust, with much amendments in the past couple of years. I now welcome Dr. Manoj Fogla, a fellow member of the ICII and holds a bachelor degree in laws and also holds a master degree in philosophy. He's an expert on taxation, CSR, FCRA, governance, and accountability issues. An author of several best-selling books for professionals on taxation of trust, NGOs, etc. Joining him, we have Suresh Kejriwal, partner, Agarwal Kejriwal and Company. Sir is mainly working for the NGO sector and has a vast experience of more than 30 years, and his professional working areas include India, Bangladesh, and Nepal. We are glad to welcome you both, sir.
Thank
the
you.
stage is all yours to take.
Yeah. So, namaskar and good afternoon. So, today's whatever time we have structured in such a way that I will give a brief context and overview of the charity-related amendments, particularly in this budget, and the context and the build-up of amendments pertaining to charity over the years. Then, because this year's amendments have far-reaching consequences and there are intricacies involved, so I will be joined by my colleagues Suresh Kejriwal. He will provide you a technical overview, and as we go along, we will discuss the controversies and debatable issues arising out of it, and towards the end, we will take up questions. So now, it was said that the charity has become one of the favorite areas. So this probably a tax department is a revenue collection department, and the government doesn't collect enough revenue from charity, but the entire half of the department is engaged in the charity, and the laws and the amount of energy is put on charity. One need to understand whether it is actually worth it and whether the government is going back and forth, or there is some pattern regarding the governance and the administration of the charity. So just to give you a context, so there are 7-8 major amendments which have come. One major amendment which have come, that corpus donation, what has happened in 2021, the government said that there is no concept of an excess of expenditure over income for a charitable organization, unlike commercial organizations. So you can spend only to the extent of income available. So if there are losses or deficit or excess of expenditure over income, that would mean that the organization has incurred it out of either borrowed fund or its available corpus. So the Income Tax Act in 2021 said that, look, this if you are spending out of corpus, if you have a deficit, then you have to maintain separate accounts, separate disclosures, and those unabsorbed expenses should continue in the balance sheet to be claimed in future years income. So in future year, you can just replenish your corpus or repay your loan against the income. That was the rationale. Even in 2021, how this will happen, how these disclosures will happen in the balance sheet was not disclosed, and even now it is not there. But this year, that replenishment of corpus and borrowings has been capped to 5 years. So it is a reverse 5-year accumulation. When you are not able to apply your income, we are given 5 years time to apply the income by filing Form 10 for 5 years, and it is a reverse accumulation. When you spend excess, make excess expenditure, then again you have 5 years. But this is quite debatable, which we will discuss, that should the corpus of an organization should be capped for 5 years, organizations having gestation period, all those issues we'll try to discuss. Then another major discussion is that in 2021 itself, the government kind of liberalized and digitized the registration related provisions. So it was kind of a welcome measure that charitable organization by virtue of that declaration can get provisional registration. That provisional registration will be live for 3 years, subject to 6 months. Within 6 months, they have to reapply of commencement of activity. All kind of charitable organizations, virtually without producing any records, based on mere declaration, were allowed to get provisional registration. And incidentally, the provisional registration was on par with the permanent registration, which is the 5-year registration on all respect, which was a bit surprising in 2021 also. And the government believes that those provisions were misused, and those provisions linked to another provision. I will tell you, in 2014, just when this new NDA government came, people used to say that it was a gift to religious and charitable institution. They brought an amendment under conditions to Section 12A. Section 12A are the conditions to registration. And under Section 12A2, two provisos were added. Those provisos provided that if a charitable organization or a religious organization gets 12A registration, then all its past assessments which are open will be treated as an exempt organization. That was a huge relief, huge gift to religious institutions, charitable institutions, which were having endowments, which were having income from FDRs, etc., but were not able to apply for 12-year registration with the fear that the income tax department, even if it gives registration, it will go after them for past years' taxes. And this is what was happening prior to 2014. Now, this honeymoon period continued till this budget 2023. Now, that provision, those two provisions have been deleted. So if you are registered, even if you are given 12-year registration, your past assessment will be subject to scrutiny and you will have no immunity from taxes. And this linked with this provisional registration. Provisional registration, many organizations were who had not applied, who had not availed exemption in the last 2 years, 2021-22, were applying for provisional registration. Immediately they were getting 12-year registration certificate, and they were further applying to the assessing officer, requesting that all their open assessment, including 143.3 assessment, etc., should be considered as if they are 12-year registered organization retrospectively. So this kind of a loophole and kind of a situation which was good for genuine organization, both way has been plugged. So it will avoid misuse of this provision, and it will again create hardship to many charitable organizations, the intent for which this amendment came in 2014. Then another major amendment, which is exit tax. In 2016, a section 115 TD was inserted into the act. This was a kind of a harsh section, in the sense it says that if an organization's 12A registration, now 12AB registration, is cancelled for some reason, then it has to pay an exit tax of 30% plus whatever surcharges on its net worth, not the preceding year's income, its net worth. All those assets created out of exemptions enjoyed would be taxed at market value. So it was quite a draconian provision, and therefore it was a non-starter. And in 2016 itself, the government, realizing the harshness of the provision, issued a circular number 21, of 2016, which instructed CITs and other authorities not to go ahead with 115 TD only in exceptional circumstances. 115 TD should be used, and in the circular itself was written that if 100 TD is used for a commercial activity of an organization or other violations, then it may create undue hardship. So this was the position of 100 TD in 2016. Suddenly in 2023, this budget says that even if you are making a mistake, even if you are making a mistake in filing a form or while applying a form, incorrect information are provided, 115 TD can be applied. So in that sense, it seems that this provision is quite in contradiction to the intent and the CBDT circular, which came with 115 TD. So we hope that some rationalization will happen as before the budget is passed. Then there are some provisions pertaining to preponment of return and filing of ITR, etc. I think all these things in a methodical manner, we should run it through with the help of Suresh ji. Suresh ji.
Thank you, Manoj ji, for setting the tone for today's session. And I shall share the overall view of the amendments made through my presentation. So basically, the today's session, I have summarized 8 key amendments, and this includes treatment of application out of corpus and loan and borrowings. The second amendment is restriction on application by way of inter-charity donations. So these 2 amendments basically restricts the amount of application which you are going to claim against the application of income. Then there are amendments whereby there is a de facto rollback of provisional registration for existing organizations. That means we are going back to the old scheme of registration for existing organizations who have already started activity. Then, as Manoj ji has said, there is no retrospective benefit for registration. Then the impact of giving false and incomplete information may attract cancellation. Again, they are saying if any organization fails to make application for re-registration, renewal, or converting provisional to regular registration, then they are subject to exit tax. Then they are again saying that the updated return, if the NGO is filing, they will not get the benefit of section 11 and 12. And they've also reduced the timeline to submit form number 9A and form number 10. And these amendments which are discussing is also being proposed for 1023C organizations as well. So the first amendment is the amount of application out of corpus and loan and borrowings. So what is the current treatment? Application out of corpus donation and loans and borrowings shall not be considered as application for charitable or religious purposes in the year of application. That is, in the year in which we are making the application out of the loan or out of the corpus fund, that shall not be considered as application. But when such corpus are invested or deposited back, or when such loans and borrowings is repaid, then such amount shall be allowed as application in the previous year in which such amount is deposited back to the corpus, or the amount is repaid to the extent of such repayment or such redeposit. So this was the current treatment. Now, what is the proposed amendment? And that is effective from 23-24. They are saying application out of corpus or loans and borrowings before 1/4/2021 are not allowed. And even if the concern without considering the fact whether we have claimed application in that respective year or not. So now they are saying any application made out of loan or out of corpus fund before 1/4/2021 shall not be eligible for such a scheme, as when the loans have been repaid, then in that year, the loan refund shall not be treated as application. Again, they are saying there should not be an unlimited period of set off, and they are putting a cap on the time limit of 5 years to restore the corpus or for the repayment of loan. Again, they are saying the amount of application out of corpus or loan only to the extent of eligible application of the concerned year. What they are trying to mean, in the first year when you have spent or when you have applied out of the corpus or out of the loans and borrowings, that application must be an eligible application. Eligible application means there should not be a corpus donation, there should not be a cash payment, there should not be an application without TDS, and there should be only on payment basis, there should not be a payment to specified persons. If all these limitations are in the application amount of this concerned year, then we have to reduce that amount from the application of that concerned year, and only the eligible portion shall be eligible to be carried forward and set off against the year in which the loan is repaid or the corpus is replenished. Our second amendment is the restriction of inter-chatty donation. The current treatment is inter-chatty donations other than corpus is treated at par with that application for the purpose of section 11(1)(a). What is the proposed amendment? They are saying only 85% of the eligible donation made by a trust or institution to another trust shall be allowed and shall be treated as application. What they are visualizing that the trust making inter-chatty donations and through cycle of series of trust, and by taking 15% of its statutory accumulation benefit, they may ending in by spending very little amount of money out of the total grant amount received. And that's why they have considered and they have provided that the 85% of the inter-chatty grant shall only be considered as application. Just to give an example through example, suppose the income was ₹100 and the inter-chatty donation was ₹80 and the other expenses was 5, the total application was 85. The surplus was 15 and the statutory accumulation was 15. That means your total income becomes nil without payment of any tax and without requiring anything to accumulate. But if as per the proposed amendment, the income of ₹100, but the inter-chatty donation shall be allowed only 85% of 80, that was only 68. ₹5 remains the same, that the total application after the proposed amendment shall be only 73. And that means the total 27 becomes the surplus and the accumulation, statutory accumulation is 15. That means the same organization end up in a surplus of ₹12, which either they have to pay tax or they have to go for accumulation or they have to go for the option to spend in the subsequent year. So this is now going to create a number of practical issues when the proposed amendment restricts the inter-chatty donation to be allowed only 85%. Now, number of issues are arising out of this, which I think we should discuss with Manoj ji. The first issue is whether or what if the amount was claimed as an application before 1/4/2021, whether it should be allowed or not now.
So now this finance bill is categorically saying that any amount accumulated prior to 2021 will not be allowed. So between 21 to 31st March 22, this provision was not there. So if the organization has claimed replenishment of old deficits against corpus or loan up to 31st March 2012, if they have claimed to that extent, it will be permissible. Beyond that, any outstanding carried forward, whether the cutoff date is 31st March, any amount which is carried forward today in the balance sheet, it will not be allowed.
The second issue is, Manoj, how to keep track of whether the amount of application has satisfied the eligibility test.
No, this is a very important issue because the ITR and other thing is about, in ITR also, it is required that the source of the funds is to be given. So when you make expenditure, you can tell that X amount was made out of income and X amount was made out of corpus or loan. But the expenditure which was made out of corpus or loan doesn't find a place in the income and expenditure account the way it used to have, or it does have in a traditional income and expenditure account of a profit and loss account. So what an organization should do, that whatever amount, whether it is a corpus investment, under corpus investment, to the extent the investment was used, scheduled to the balance sheet, the same expenditure should be there, and the auditor should audit those expenditure as a schedule to the balance sheet, and the audit notes should be provided and the trail should be available. Otherwise, in future year, it will be difficult to claim because these expenditure do not find a place in the income and expenditure account. Therefore, they should find a place with the normal audit and the accounting process as a schedule to the balance sheet and appropriate audit notes. Otherwise, it will become difficult.
And the third important issue is how to treat the amount if not invested back or to the corpus or loan is not repaid within 5 years.
And this is what we were discussing, that this is the difficult part, because organizations, sometimes there are large institutions, big organizations, initial few years they work out of corpus or promoters fund or the settler provided trust funds. So if an organization has a large gestation period and it is not generating enough revenue for a few years, then it will be extremely difficult, because 5 years suddenly, to that extent, your corpus is struck off from the balance sheet. So the only option we see, unless this provision is rationalized, to that extent, the existing capital fund or the corpus fund of organization should be reduced by setting off, striking off the debit balances or asset side 50 CS balances available. So the capital fund has to be reduced to that extent.
Thank you, Manoj. Now we shall discuss about two important amendments regarding rollback of the provisional registration to some extent, and vis-a-vis the no retrospective benefit of the registration. So what is the current position for the rollback of the provisional registration? The trust or institution which has already commenced the activity is required to file registration application in 2 stages as per the present law. First, they have to apply for provisional registration, and once the activity starts, they have to apply for a normal registration. And for the existing organization who have already started the charitable activity, they have to immediately form second form for normal registration once they get the provisional registration. So it was basically a two-way registration, two-way system to make the registration normal, though it could have been made one. The proposed amendment for such cases, they are proposing that the trust institutions shall make an application for regular registration who has already commenced the activity, but it has not claimed exemption under section 1023C or section 12, 11 or 12 for any of the previous year ending and or before the date of application. So now the amendment is saying we are not advocating for two-way system. When the organization has already started activity, they should go for only one-time application, and the CIT exemption will examine and give us give them the registration certificate. This is in line with what the old system was. But at the same time, they've also added the word that the organization who are making for this registration, they should not have claimed exemption under section 1023C or section 1112 in the past. That means any existing organization who have not applied for re-registration, they cannot file a provisional registration once this act is passed. Earlier, what we are doing, the old organizations which have missed the deadline to submit the re-registration form, we are asking them to go for a provisional registration. But after this amendment come, I think that remedy will not come to their rescue. However, those trusts which can continue to have a two-way system which has not commenced their activity. Now the second amendment is no retrospective benefit of the registration. What is the current position? The provision to subsection 2 of section 12A provides that the benefit of registration shall be granted to all the past assessment pending before the assessing officer as in the date of registration. Again, the provision says no 147 proceedings can be initiated merely on the ground that the trust is not registered. Again, the provision says that the above benefits shall not be available if the trust has applied, but his application has been refused. So basically, as per the present scheme of law, once the trust is registered, they are getting the benefit because of this provision of the assessment for the back years, and their back years were also not reopened only because they are not registered. And that's prompted and that encouraged most of the NGOs to regularize under Income Tax Act by getting the registration. But as per the proposed amendment now, the finance bill has proposed to omit all these three provisions, and therefore the benefit of exemption for the past years will not be available. Now the issue is, Manoj, should the organization apply for provisional registration and then commence the activity, or apply directly for regular registration after commencing the activity?
No, this provisional registration, as we said, that those provision of online registration, digitization of registration, availing the registration directly, all those amendments now have gone out of the window, because provisional registration is valid only till you commence your activity. Our understanding of commencement of activity is that even if you spend a single rupee towards charitable or religious purposes, the activity is commenced. So there would be very few organizations which would not be having some activity. In any case, there is a 3-year requirement of balance sheets and income and expenditure accounts. So practically for almost all the organizations, except new registration, there is no option of provisional registration. And for new organization also, the moment you apply for provisional registration, immediately the moment you spend a single rupee, you have to apply for regular registration within 6 months. So therefore, all practical purposes, the direct registration of the old regime is the only option left, and that is what should be done.
Now the second issue comes, Manoj, as per the present law, organization need to apply 1 month before the commencement of previous year for the purpose of registration, and at the same time, this bill proposed to withdraw the back year's benefit. Now, what shall be the impact on the existing organization who want to regularize themselves?
No, that is the key question, because this has been timed with deleting those provisions under section 12A. So it is not a coincidence. This exactly is the issue in the mind of the department, that they will not spare the earlier year assessments, and we are going to see 147, 148, 143 assessment on a continuous basis. So, and maybe this 1 month part, the technicalities, you can just explain it a little more.
Yeah. No, basically, as Manoj has said in his introduction remark, as because of this proviso, even if 1 month prior to the commencement of previous year has got no impact, because the organization was applying for a provisional registration, getting it, and automatically they were eligible for the past year benefit. But after this withdrawal, I think it will have a great discouragement for the existing organization to get themselves registered, and without looking at their past accounts. Now we shall deal with two amendments dealing with the applications being submitted containing some incorrect information, and is not moving slide. So the first is giving incomplete and false information can attract cancellation. The first amendment for this, and as per the current position, cancellation proceedings can be initiated if the PCIT or CIT has noticed occurrence of a specified violation, and the violation need not be noticed only upon assessment. And if the registration has been obtained on incomplete or false incorrect information, the CIT has a power to cancel the registration after giving an opportunity of being heard, and this is provided under Rule 17A6. That is, under Rule 17A6 provides that if the information in the form is not complete, or it is a false information, then the CIT has a power to cancel the registration after giving an opportunity of being heard. But similar provisions are not there in the specified violation list under ATB 12AB4. Now, as per the proposed amendment, expiration to section 12AB4 provides a specified violation which results in cancellation. And a specified violation after this amendment shall include the case where application for approval or registration is incomplete or contains false or incorrect information. I understand this amendment is basically facilitate the what has been mentioned in the rule, so that so the rule get more legal validity. Now, the more important change and proposed change is the exit tax under section 115TD. Only on the failure to make application for registration or renewal or for converting the normal provisional registration to normal registration. What is the current position? As per the new registration requirement, every existing registered organization under section 12A, 12AA need to be re-registered. Again, the re-registration shall be valid for 5 years, and thereafter this again has to be renewed. Again, once the provisional certificate is granted, one need to apply for a normal registration. So these 3 applications one need to apply depending upon his situation. And what is the proposal? And there was no clarity in the law. What will happen if one fails to apply for a re-registration, one fails to apply for re-registration, and though it was very clear that the organization shall not be deemed to be a registered organization for the purpose of assessment, but whether it will tantamount to cancellation, that was no clear. There was no clarity. The proposed amendment, what they are saying, as per the proposed amendment, where application are not made for any of the above situation, or all the three situations, then the organization shall be deemed to have been converted into any form not eligible for registration or approval. In a previous year, under section 115 TD of the Income Tax Act 1961, and shall be subject to exit tax. So now the proposed amendment are saying, if you fails to apply in any of the above situations, that is, you have not applied for a re-registration, you have not applied for a renewal, or you have not applied for a provisional registration to normal registration, then your organization deemed to be converted into a form not eligible for registration. And they're also providing that the date of deemed conversion shall mean that last date of making an application for registration. Meaning thereby, if the last date of making the application is 30th September, and you have not applied by 30th September, then the date of deemed conversion shall be the 30th September. So this, I think, is very, very going to have a very, very great impact to all the NGOs, and basically those NGOs which have not yet applied for re-registrations. Now the issues here, Manoj, what shall be the impact if organization registered under section 12A and 12AA has not yet re-registered? And keeping in view of the circular dated 1/11/22, where the existing timeline for submitting application to re-register has extended up to 25/11/22.
No, again, this circular was intended to give some benefit to the organizations who failed to apply, and the date was extended. But by virtue of this amendment, this circular, those who have not applied, for them the last date is no longer 31st March 22. It has become 21, and it has become 1/11/22. So in such circumstances, we think one more assessment year will get implicated, and the organizations which had the circular not come, then the organization would not have been under 115 TD. But now this organization, because of this circular, will get implicated under section 115 TD. And just to again put it, it is important to reiterate that 115 TD under after Finance Bill 2023, read with section 12AB violations, is quite absurd, because 12AB, which was earlier section 12AA, it provided that if the organization is not genuine, or an organization which is not a charitable organization, a commercial organization, or some organization with some other motive under the garb of a charity or religious organization, if it has taken registration, then 115 2D should be applied and cancellation should be done. 1. 2. Cancellation presupposes certain serious violations. Violations is that making misrepresentation or misusing of form which has resulted in leakage of revenue to the organization, or wrongfully exemptions have been taken. So this was the spirit, and this was the provision in the law. And this is how 115 TD came in 2014, and the corresponding section 12AA only provided for these kind of violations. Now 115 TD will be invoked if you provide incorrect information. If you fail to manage books of account under section 11(4)(a), suppose you have incidental business activity and you have not maintained books of account. So if you don't maintain books of account under 11(4)(a), in any case you will be taxed. That itself is under 11(4)(a) also it is a penal provision, and the organization will be subjected to various provisions of the law, penal provisions of the law under 11(4)(a) also. Then treating it is a reason for cancellation, or while filing the form, if the informations are incorrect, which does not result to misrepresentation of fact or claiming wrongful tax benefit, Those kinds of circumstances have also been included under 115 TD. It is quite harsh and a bit surprising that this is how these cancellation provisions have been structured over the years. Now cancellation provisions include small clerical error also can be a reason for cancellation. So this was not the intent with which 12A and cancellation provisions were inserted at the time when they came into the statute, but the shape has changed. So the purpose of 115 TD, purpose of 12A, and the application has totally changed. So I have reiterated, just keeping in view the intensity and seriousness of this provision.
Yes, Manoj, you are very right. And by all these amendments, now it is very clear that there is no exit route. Once the organization is registered under Section 12AA or 12AB, then they can't surrender the license. They can't, even they fails to make the application, the 115 TD is there. So if the only when you want to get rid of this registration, then you have to pay 115 TD tax now. So now, after all these amendments, there is no exit route without 115 TD if you want to get out from the registration process. So there is now no exit route. Now we shall discuss two more amendments to end with. The first amendment is the benefit of exemption will not be available if we are filing the updated return. What is the current position? The Finance Act 22 has inserted subsection 8A in section 139 to enable filing of updated return. And nothing in the law that restricts the filing of the updated return by the institutions and claiming exemption under section 11 and 12. So as per the present law, that doesn't restrict when the updated return is filed, the NGO will not able to claim the exemption benefit. Now, what is the proposed amendment? The return of income shall be filed within the time allowed under section 139(1) and 39(4). Now, the conditions to submit return, the requirement of submission of return is one of the conditions to claim benefit. Now, earlier, the return of income shall be filed within the time allowed under section 139 was written, not 139(1) and 4. Now, as per the proposed amendment, if you want to claim the benefit of section 11 and 12, then the return has to be filed within 139(1) or 139(4), meaning thereby returns filed in pursuance of 139(8)(a) will not be subject to 12A registration benefit. And therefore, at the time of filing of return, updated return, the benefit of registration under section 12 and 11 will not be available. Now, another amendment is the preponement of the time limit to file form number 9A and 10. We don't know why this has been done. The reason mentioned that because the auditor has to give the report by September, where form 9 and 10 has not been furnished, and difficult on the part of the auditors, and that's why they are proposing the time limit to 2 months. They could have also said it 1 month so that both the work can be done simultaneously, but instead of 1 month, they have put it 2 months. So as per the current position, minimum 85% has to be spent, and shortfall in application, either you can apply 9A to spend in subsequent year, or you can go for form 10 to accumulate for 5 years. And the present time limit for filing 9A and 10 is within due date of the furnishing of the return. But as per the proposed amendment, the time limit has been reduced to at least 2 months prior to the due date of filing of return. That means if the 31st October is the due date of the submitting return, then 31st August becomes the deadline for submitting form number 9A and 10. Now the issue, Manojji, for the updated return, they are saying the benefit of section 11 and 12 will not be available because the returns is not furnished under section 139(1) or 139(4). So whether the benefit of section 1310 or 1311 shall be available, because section 1310 and 11 inserted from Finance Act 22 provides that if there is a violation of filing of return in terms of the requirement, then the income has to be computed in a different way as provided in this section.
First, Sureshji, I would request you to just to give a context of section 13 and 11 to our viewers, because everybody might not be. Maybe you can this little bit. Yeah.
So the Finance Act 22 has inserted section 1310 and 1311 to take care of certain specified non-compliances. And those non-compliances where you have not submitted your 10B report in time, you have not submitted the return as per the prescribed timeline, or you have more than 20% of your business receipt in violation of section 215. And all those violations will result in withdrawal of benefit of section 11, 12, and 13, and the entire gross receipt were subjected to tax. So as a welcome provision, last year, last budget, section 1310 and 1311 has been introduced. And they are saying all these three violations, there will not be a complete withdrawal of benefit of section 11, 12, 13. But in such cases, the income shall be computed in a different manner. And what is that different manner? They are saying only out of the income, only the revenue expenditure shall be allowed. That means no allowances for capital expenditure. They are again saying no inter-charity grant shall be allowed. So they are saying only revenue expenditure can be claimed against the income if there are specified non-compliances. And again, there is no benefit of statutory accumulation. There is no benefit for any option to be excised. So basically, the NGO can claim the revenue expenditure even if those violations or non-compliances are there, provided this revenue expenditure is not in cash or the TDS have been paid. So these are the framework which has been introduced last year. And again, this year for 139.8, the non-compliance is only due to the filing of return. And that's why the issue comes whether the updated return though is non-complying with the filing of return timeline, whether they can claim the benefit of section 1310 and 1311 or not. And I think Manoj, we can
yes, you can continue, you can complete this.
I think the concerned NGO can claim the benefit of section 1310 and 11 because this specified violation has already a separate provision to deal with. And therefore, even if there is a complete, there is no, in the intent of the memorandum, it is saying the complete withdrawal of the benefit, but the way it is changed, the way that the section has been modified, it becomes the non-compliance of submission of return, and those submission of non-submission of return or submission of return after the due date has a privilege or has an option to take the income computed under section 1310 and 1311. Now the second issue is, Manoj, what shall be the impact of preponing the time limit of submission of form number 9 and form number 10? Because earlier it was within the due date, now 2 months before the due date.
No, it will have a cascading impact because an organization cannot possibly know and completes its account. So it presupposes that all its accounts and returns should be completed 2 months prior to the filing of returns. So for all practical purposes, the organization has to be prepared unless the due date of return is extended for charitable institutions separately. So, and if the Form A and 9A are not filed 2 months prior to the normal filing dates, then I think the NGOs are going to face, the accountants, the auditors, everybody are going to face a difficult time. Would you like to add anything?
Yeah, you're right, Manoj. Because after reporting of this rate, basically the last date of submitting return de facto becomes 31st of August. Though the Act provides to submit by October, but when you have to determine the amount of accumulation or amount of option to excise next year, that means you need to finalize your accounts. And once this amount has been finalized, there's no point waiting to submit the return. So in fact, by this change in the timeline, will require may compel the organization to finalize their accounts much ahead, and which I find shall be very, very difficult for most of the NGOs which have a wide working locations in different areas. So these are some of the 8 amendments, and we have also discussed some of the issues. Now it is open to the House for any issues to be discussed.
Sir, can I take the queries now?
Yes.
So one of the query is, in light of the slew of amendments and rulings in recent years concerning public charitable trust, is it correct to comment that going forward, approval under section 11, 12, and 80G, as well as monitoring of compliances for such trust, has become very onerous and cumbersome, requiring review and relook of their activities by every such trust?
No, that is certainly a fair comment. It is for trust, it is already very onerous. And if you see the ITR 7, most of the demand and assessment order we feel are due to mistakes in filing ITR 7. Not that the consultants are incompetent, but the forms and the rules, etc., are so complex and so many contradicting. And even if one particular field there is some error, there are multiple fields where same information can be filled. So already the compliances are cumbersome, and the cumbersome and tediousness of compliances is resulting in huge litigations. I can give you, without looking, I can give you example. We in the recent past we have handled where the demand of 30 crore, 40 crore rupees of tax demand, attachment, 20% deposit, etc., were raised, and ultimately when we approached the jurisdiction AO, we were able to get the entire amount reduced because it was just a technical error or it was a problem. So the trust's recording onerous, that is one part compliance. The second part is the intent. The intent also seems to be very clear that the trusts have to have work into a very limited frame, and they will have a very small space. Virtually, the possibility of creating corpus has been reduced. So in that sense, what he's saying is correct.
Correct. So next question, how will the restriction on inter-charity donations impact the project grants or the restricted grants?
That again is a very important question, because this law, because if you see section 224 subclause 18, there is a provision which says that government grant will be treated as income. So in specified grant, it doesn't include. So in that sense, restricted grant legal obligations have always been kept out of the scope of income. But the way the amendments are coming, the rules are being framed, and the ITR form has been structured, that there is no scope of disclosing or claiming restricted grants. So if you go to the ITR 7 form, it is either voluntary contribution or corpus donation. There is no other field of grants received. So therefore, what we understand that there is some kind of a dichotomy where the Act, the judicial precedents, the Supreme Court, High Court allows restricted grant. We keep on receiving orders from the CIT appeal tribunal allowing restricted grant as non-income. But the law is structured in such a way that all corporate grants should be treated as income and 85% application will be allowed. So that maybe it should be addressed. So it should be a part of some representation. Some sanity should come. Or formally the government should make restricted grant as an artificial deemed income, the way voluntary contribution has been made income. That either one should be done.
Great. So the next question, sir, is how the amendment restricting inter-charity donations to 85% may have an impact on the amount that mother NGOs or corporate foundations pay to small charitable organizations.
Now, mother NGOs are going to have extremely difficult time. In the sense, mother NGOs, when they used to give grant, then suppose mother NGO has received 1 crore rupees, it gives inter-charity grant of 1 crore rupees. Right. Then the mother NGO, if it has some internal accrual, up to 15 lakh rupees, it can accumulate. But now the mother NGO, even though it has remitted 1 crore rupees, its income and expenditure account will show only 85 lakh applications. So in that sense, it will be extremely difficult for mother NGOs to accumulate. That indefinite accumulation is virtually withdrawn for mother NGOs. So that is one major impact which mother NGOs will have. And the other impact will be that the other NGOs will be left with this admin expenses at their end, and there will be, so it will have quite a cascading effect on the functioning of large, particularly corporate foundations.
I think as per the intent of the amendment, the amendment should be that the receiving NGO, the statutory accumulation should not be on the grant income. In spite of that, they have reduced the amount of application by 15%. If that easily said, therefore the receiving NGO inter-charity donation, the statutory accumulation will not be available on that part of the income.
And one more thing I must add, suppose in case of withdrawal of exemption or in case of application of section 1310, etc., it will create confusion because artificially only 85% of the expenditure is allowed, because this inter-charity donation is not in capital expenditure. So that way it will also create confusion in future assessments.
Okay. So shall I take 2-3 more questions, sir?
Yeah.
So next question is, NGO was having a registration under 12A for past 20 years, but not applied for renewal till now. What shall it do now?
Now it will have to pay exit tax under 115 TD. After it pays exit tax, it can consider applying for 12A again. So this
what is the proposed amendment? But if you want to take a risk, he can apply for a provisional registration, because as of now he is not being till the act is passed. I think Manoj, he may apply for a provisional registration and can take a
right.
Because this registration mechanism changing from 1st October 2023, and this act is changing, not yet passed. So many of the organization has gone for the provisional registration as of now.
But even if you take provisional registration, you will find it difficult to get the regular registration.
Yeah, that is a
correct. And whether registration for trust is compulsory before applying under section 12AA?
Registration as a society trust, that is what you are saying?
It's a maybe yes, it's asking for that because registration of a trust is written this way.
Yes. So technically, even an unregistered organization is eligible for 12A registration. There is a Supreme Court ruling in which Supreme Court held that an old trust, which are oral trust, even oral trust can by virtue an affidavit and local affirmation, they can apply for 12A registration. So technically under Income Tax Act, registration is not a prerequisite.
Correct.
Even an unregistered, but for all practical purposes, it has to be registered. These are for academic interest only, or in exceptional cases, it has to be registered.
The next query is, if renewal of registration for assessment year 22-23 not filed, can the trust file for renewal for assessment year 23-24 to avoid tax on corpus money at the end of financial year 22-23?
No, renewal is a totally different provision. Renewal is not related with what the trust has done or not. So that renewal window is closed. Renewal window is closed on that 11 November 2022. So if all those registrations have lapsed, I don't think renewal is any more possible. Suresh ji?
No, not possible. And that's why the first query which come to applying for provisional or not. Yeah. So renewal window is closed.
Correct. Then we have project grant donation in kind to other NGO, also eligible 85% only. Please clear.
No, project grant, as we said, that project grant, if it is treated as a part of your income, then it is subject to the same 85%, the inter-charity grant, and most of the organizations treat it as a part of income and 85% application. And as we said, there is judicial precedence. Some organization treat as restricted grant, but it is mostly subject to controversy and litigation.
Correct, sir. And one last question we have. 85% cap is applicable only for donation or also for grant, I think, for which recipient charity has furnished utilization certificate.
Yes, the 85% cap is not related with grant donation. 85% each income from property of the trust, which includes voluntary contribution, which includes grant, unless it is restricted grant.
Okay, perfect. Great, sir. Thank you so much for such a valuable session. I think this topic is a very hot topic all the time during the budgets. So having a session on this is truly worth it, sir. Thank you so much.
Thank you.
Thank you, Suresh, sir. Thank you, Manoj.